Hello everyone, you are highly welcome to our channel. In today's videos we will discuss about cryptocurrency regulations and impacts on the markets. The emergence of cryptocurrencies over the past decade has brought about a new kind of digital currency that has the potential to revolutionize the way we transact value. However, with this new technology comes regulatory challenges that have yet to be fully addressed. In this paper, we explore the current state of cryptocurrency regulations and their impact on the market. Over the past decade, cryptocurrencies have emerged as a new form of digital currency that allows for secure and decentralized transactions without the need for a central authority. Bitcoin, the first cryptocurrency, was created in 2009 and has since been followed by a number of other digital currencies, including Ethereum, Ripple, and Litecoin, among others. While the adoption of cryptocurrencies has been relatively slow, they have garnered significant attention from the media and investors alike. However, the rise of cryptocurrencies has also brought about a number of regulatory challenges that have yet to be fully addressed. Cryptocurrencies exist in a legal gray area in most countries, largely because they do not fall neatly into the categories that traditional financial instruments do. This lack of regulatory clarity has led to concerns around money laundering and terrorism financing, as well as questions around investor protection and consumer rights. The purpose of this paper is to explore the current state of cryptocurrency regulations and their impact on the market. Section 1. Overview of cryptocurrency regulations. In this section, we will provide a brief overview of the current state of cryptocurrency regulations around the world. We will examine the different regulatory approaches taken by various countries and regions, and discuss the challenges and opportunities presented by each model. 1.1 United States. The United States has taken a somewhat mixed approach to cryptocurrency regulation. This guidance mandated that cryptocurrency exchanges comply with KYC, Know Your Customer, and AML, anti-money laundering, regulations, and established requirements around record-keeping and reporting. However, the U.S. has yet to introduce comprehensive federal legislation specifically targeted at regulating cryptocurrencies. New York was the first state to introduce cryptocurrency regulations, with the introduction of the BIT license in 2015. The BIT license is a business license that is required for any firm engaging in virtual currency business activity in the state of New York. However, the BIT license has proved controversial, with some arguing that the onerous requirements make it difficult for smaller startups to comply. 1.2 Europe. Europe has taken a more proactive approach to cryptocurrency regulation, with a number of countries introducing specific legislation around the use of virtual currencies. In 2018, the European Union introduced the fifth Anti-Money Laundering Directive, 5/AMLD, which requires member states to introduce regulations around cryptocurrency exchanges and wallet providers. These regulations include the requirement for KYC and AML processes, and mandate that exchanges be licensed and registered with national regulators. In addition, a number of European countries have introduced their own cryptocurrency-specific regulations. In Germany, for example, cryptocurrency exchanges are now treated as financial service providers and are subject to regulation by the nation's financial regulator, BaFin. Similarly, in France, cryptocurrency exchanges are now required to register with the Autorité des Marchés Financiers, AMF. 1.3 Asia. Asian countries have taken vastly different approaches to cryptocurrency regulation. In China, for example, the government has been hostile to cryptocurrencies, banning initial coin offerings, ICOs, and shutting down cryptocurrency exchanges. In Japan, however, cryptocurrencies are now recognized as a legal form of payment, with exchanges subject to licensing and regulation by the Financial Services Agency. In South Korea, the government has taken a more cautious approach to cryptocurrency regulation. While exchanges must comply with AML and KYC requirements, the government has yet to introduce comprehensive legislation specifically targeting cryptocurrencies. Section 2. Impact of regulations on the market. In this section, we will examine the impact of cryptocurrency regulations on the market. We will explore how regulations have affected investor behavior, and how they have impacted the development of the cryptocurrency industry as a whole. 2.1 Investor behavior. One of the key impacts of cryptocurrency regulations has been on investor behavior. In countries where regulations are stricter, such as Japan and France, there has been a noticeable shift towards larger, more established cryptocurrency firms. This is because these firms are more likely to have the resources to comply with regulatory requirements. In countries with looser regulations, such as the US, there is a greater likelihood of smaller, less established firms operating in the cryptocurrency space. 2.2 Impact on industry development. Regulations can also have a significant impact on the development of the cryptocurrency industry as a whole. Stricter regulations can make it more difficult for startups to enter the space, as compliance costs can be prohibitively high. However, regulations can also provide a degree of legitimacy to the industry, which can help to attract more mainstream investment. Moreover, regulations can also encourage innovation within the industry. For example, regulations that require stronger AML and KYC processes can encourage the development of more sophisticated blockchain-based identity verification tools. Similarly, regulations around custody and security can lead to the development of more secure and reliable cryptocurrency storage solutions. Section 3. Future of cryptocurrency regulations. In this section, we will explore the potential future of cryptocurrency regulations. We will examine the key regulatory trends that are emerging in different parts of the world, and discuss the potential implications for the cryptocurrency industry. 3.1 Global standardization. One of the key trends that is emerging in the cryptocurrency world is the push for global standardization. Organizations such as the Financial Action Task Force, FATF, are working to develop global regulatory frameworks that can be adopted by countries around the world. This would help to create a more level playing field for cryptocurrency firms, and would make it easier for firms to operate across different jurisdictions. 3.2 Focus on investor protection. This is driven in part by concerns around fraud and scams in the cryptocurrency space, but also by the fact that cryptocurrencies are often seen as a highly volatile asset class. To address these concerns, regulators are introducing rules around investor disclosures, as well as requirements for firms to offer greater protection to their customers. Finally, there is a growing trend towards greater clarity in cryptocurrency regulations. The lack of regulatory clarity in most countries has made it difficult for the industry to develop, and has led to concerns around fraud, money laundering, and investor protection. These regulations are helping to create a more stable and predictable regulatory environment for cryptocurrency firms, and are encouraging the development of more sophisticated tools and technologies. Don't forget to like, share, comment and subscribe to our channel so you can get notified when we upload new video.